Hello, everybody. This is Tim Travis with TNT Capital Management. And today we're going to go over our January 2026 investment strategy webinar. So it's an interesting dynamic. This market is very overvalued on just about every metric. It's one of the most expensive in history. The only potential exception is 2000, when the NASDAQ proceeded to drop by 80% from peak to trough over the next 3 years. So what we're going to do is we're going to go over some things. First of all, disclosure: investing in the financial markets involves the risk of loss. Options are not suitable for all investors, and past performance is not indicative of future results. How do we invest? We look for undervalued stocks and bonds that offer less risk and better returns than the overall market over the long term. So, in addition to these types of securities, we employ conservative income generating strategies such as covered calls and cash secured puts to reduce risk and enhance the income. And we do not do any speculation. So, we don't do any gambling, we don't do any kind of like technical or timing trading, other than utilizing the options, which have that element of timing to them. So it's a very value investment driven, fundamentally driven philosophy. Now, Seth Klarman, he says in 2008, he says, uncertainty is not the same as risk. Indeed, when there's great uncertainty, such as in the fall of 2008, it drives security prices to especially low levels. So they often become less risky investments. So think about that. So when everyone's scared of the market, that's when the value is most pronounced. When everyone is optimistic, which kind of feels how it is now, that's usually when maybe you should be scared of the market. So valuations are frothy, and so concern might be warranted. Now you look at market valuations. The current Shiller, the inflation-adjusted PE, is 40.91. So that's nearly 50% higher than the recent 20-year average of 27.4. And that 20-year average is higher because we've been in a period of high valuations. The regular PE ratio stands at 29.6, which is 80% higher than the historical average of 16.5. 10-year treasury yields yielding about 4.15, junk bonds 6.49. So this is a very speculative driven market. Okay. It's not one where investors are showing a lot of concern or caution. Now, here's a quote I like from Niccolo Machiavelli, the great philosopher to the Medicis. And he said this in The Prince, his book. He said, "It is a common fault not to anticipate storms when the sea is calm." So, when you have had multiple good years in the market like we've seen recently, it's easy just to think that, okay, hey, this is how it is. It's recency bias. We're just going to invest in the S&P 500. You're all good. Nothing to worry about. But the problem is there's a ton of risk there. I mean, if you're 100% invested in stocks, you need to be comfortable taking a 40-50% return. That's a inevitability at some point. So if you're in retirement or close to retirement, you might not be able to take that risk. So it's important to anticipate storms before they come and be prepared. Now, how do we set you up for success? Every investment is handpicked and thoroughly researched based on deep value principles. We build focused portfolios based on maximizing risk-adjusted returns as opposed to the overly diversified approach others take. And we utilize strategies such as selling covered calls and cash secured puts, which can potentially generate reasonable returns in poor market conditions and which generally result in less losses in bear markets. Now, I just want to draw your attention to the phenomenon we've seen. So the last several years, most of the performance in the S&P 500 has been driven by the top 10 stocks. So you can see that from 2020 to 2024 is nearly 60% those years, most of those years. Last year in 2025 was about 50%. So it's a top heavy market, and a lot of that has to do with indexing, right? Because indexing is valuation agnostic. If you put money into the S&P 500, it's going to go into the largest companies. That's just how it works. It's a cap weighted index. So the Nvidias, the Alphabets, the Microsofts, the Apples, that's where the money's flowing. Now, if that cycle were to reverse and people start, getting out of the market, the same thing would occur where more people are going to be selling those larger stocks. So it's something that has gotten to a very high level, and it works until it doesn't. But it's something to pay attention to. And here's just another thing where you can see it. So right now we have one of the most concentrated markets in history. So the top 10 largest stocks are at 35%. So this is a very, very concentrated market. Once again, if you see weakness in some of those larger names, it's definitely going to drive the markets down, barring a major cyclical rotation. Now, what we want to do when we're investing is we want to seek a margin of safety. This is what made Benjamin Graham, Warren Buffett's mentor, so famous. He says, a stock is a fractional share of a business. Every business or stock has an intrinsic value. The intrinsic value of a business generally changes at a much slower rate than the price of a publicly traded stock can change. Over time, the intrinsic value of a business and the stock market value of a business converge. It could take 90 days and it could take 3 years. The timing's always the hardest part. But by buying the business at a substantial discount to intrinsic value, you are thereby creating an adequate margin of safety. So here's another quote from Buffett. He says, I would consider a year in which we declined 15% and the Dow declined 30% to be much superior to a year when both we and the average advanced 20%. Over periods of time, there are going to be good and bad years. There's nothing to be gained by getting enthused or depressed about the sequence in which they occur. So once again, the 1990s, there were, tech funds that were returning 50%, 70%, 100% on various years. And people, there were magazine covers that said Buffett had been left behind, he had lost it. Almost all of those funds went out. They're gone. They're gone because it was a totally unsustainable bubble driven run. And that's, I think we're seeing some similar dynamics now. So you want to be aware of that. You want to be invested based on business like principles. Okay. So one of the things that we do is we use options as a tool. So there's some inherent advantages towards selling options. About 3/4 of them held to expiration expire worthless. Okay. So we've seen that in practice. And what we do is we use options as a tool to add that element of timing, which you do not have when you're just buying stocks. We use them for the purposes of generating income, reducing risk, lowering our cost basis, and selling at prices that we are comfortable selling at, not speculation. So let's take a look. This was our worst stock of 2025, Alexandria Realty. So they own some of the top scientific biotech labs and office space in the country. So it's predominantly in clusters, around Maryland, in the Research Triangle, San Diego, the Bay Area, and it's where most of these large companies like the Novo Nordisk and AbbVie and Amgen, they have labs in these various areas, and Alexandria's got the best footprint. So a couple of years ago, this stock was trading at over $200 a share with virtually the same real estate footprint that it has now. And its 52-week range was 105.14. On January 14th, it was trading at 54.64. So about 48% below its 52-week high. Now, the company is facing some issues. So there was kind of a supply bubble that occurred after COVID, and so that's been working its way through. And then the current administration with RFK Jr., they have different priorities. Obviously, they've made some changes to the childhood vaccine regimen, and that's kind of scared a lot of biotech companies. So they're not really expanding off this space as much. And so that's been an issue. So there's a little more of the supply overhang is lasting a little longer. The company had a bad third quarter and the stock dropped quite a bit. They ended up cutting their dividend. This is an investment grade balance sheet, very high quality company. It's known as, I mean, this has a great reputation, but it's in a period of underperformance. It's probably going to take, a year until things start to look a little bit better. But here's the thing, folks, valuation. So the dividend yield after being cut is 5.3%, so 288 per share. It trades at only 8.54 AFFO. So that's their kind of cash flow metric. That normally was in the high teens to low 20s. Okay. So this is a dirt cheap stock with an investment grade balance sheet. If the stock trades to just 15, it's dramatically reduced AFFO this year because we know earnings are likely to be down this year. But I think that's a very temporary phenomenon. I think they'll start growing again quite a bit after that. If it can get to 15 times trough AFFO, the price would be 96. So that's nearly 76% higher than the current price. Plus, you collect the 5.3% dividend. So bad investment so far. No ifs, ands, or buts, but the upside opportunity is as good as almost anything out there, in my opinion. And most analysts peg that the value of the real estate's 105, 115. So very undervalued stock. Next one, MSDL. So this is Morgan Stanley Direct Lending, and this is a business development company. So what they do is they basically own a diversified portfolio of first lien loans. Okay. And all of these deals, a lot of them are originated by Morgan Stanley's investment bank. And so think of it as a loan portfolio. And right now it's trading around its 52-week low. So it was at 1631 on the 14th. So that's 25% below its 52-week high of 2175. The stock sports a dividend yield of 12.26%. So every share pays $2 a share dividend. So huge yielder, huge, massive cash flow machine. And importantly, it trades at a 20% discount to its third quarter net asset value. So remember, it's a loan portfolio. It's trading at a large discount to that net asset value. So historically, it's traded right around net asset value. This is a very high quality portfolio. Non-accruals are very low. They have almost all first lien, very little payment in kind loans, which some people worry about a little more. Now, because the Fed has cut rates, and because these loans are usually adjustable rates, the cash flows could go down a little bit over the short term. And so I don't leave out the possibility. There is a chance the dividend gets cut in a couple quarters. And I think a reasonable, very conservative dividend would be $1.60 a share. So even if the dividend were cut, the stock would still yield 10%, and you'd have 25% upside on top of that if the stock can trade to its NAV again, as it has in the past. So this is a stock that I would expect to return double digits over the next couple of years. And I think the risk level is pretty low. Next one, Vici. Okay, so this is real estate investment trust, triple net. They own a lot of the big casinos in Vegas, such as the Venetian, Caesars. They own a lot of them from both MGM and Caesars, and they also own some regional ones. They're diversifying into other kind of entertainment-based assets, such as Bolero bowling alleys and stuff like that. Trading right around its 52-week low at 2781, 18% below its 52-week high of 3403. The stock yields 6.47%, so it pays $1.80 per share dividend, and it trades at only 10.15 times AFFO. So this is insanely cheap. I mean, this is one that has traded at 15, 17, 18 times FFO, their cash flow, because of the quality of these assets. Like during COVID, for instance, when almost nobody was paying rent, Vici's tenants, all of them paid rent. They're good credits. Now, if the stock trades at just 15 times FFO of 275, the price would be 41.25, which is 48.33% higher than the current price. Plus, you'd collect that 6.47% dividend. So very, very attractive stock, very high yield. We don't think there's a lot of risk here. And I mean, these are gems in a portfolio, especially for retirees. OBDC. So this is Blue Owls, another investment manager. It's their business development company. So the stock on the 14th was trading at 1244. The 52-week high is 1573. The dividend yield is 11.89%. So it pays $1.48 per share. The book value per share, the net asset value, is trading at 1489. Okay, as of Q3. So the stock trades at about a 16.45% discount. Now, if the stock trades at NAV again, so just like MSDL, the stock would rally by about 20%, plus you'd collect that 11.89% dividend for a total return of 31.59%. So once again, because you're buying it so cheap, you're buying a well-run, high-performing collection of loan assets at a large discount to its net asset value. You're getting a huge dividend. This is a great opportunity. And, if the stock market doesn't do that great, these types of investments can still perform pretty well, especially if credit holds up all right. So It's not risk-free, but it's a attractive opportunity in our eyes. Fiserv. So this is a payment processor, okay? They have a lot of kind of those portals that you check out on restaurants, and you swipe your credit card. They have a lot of the payment infrastructure, and this was another glamour stock. 52-week range, folks, was 238.59, and now it's just a little above its 52-week low at 66.75. So undervalued stock. It's got some hair on it, just because they reduced their guidance. They had a lot of exposure to Argentina, and some of the changes down there have kind of hurt the prospects for Fiserv. But so what we're going to do is we're going to sell 1 January 2027 $50 put for $4.50 a share. It's $450 a contract. So maximum risk is $4,550 if the stock were to go to zero. Obviously, we don't expect that. Heads or tails? Two things can happen. So heads, if Fiserv, which is at 66.75, expires above 50 in a year, you will collect the full target profit of $450 or 9.9% on the maximum risk. If the stock expires below 50, you're going to own 100 shares at a break even of 45.50. And now you've got all the upside or downside from there. So therefore, the stock could go down 32% by expiration before you lose a penny. So think about that. Bear market's 20%. This thing can do more than a bear market before you lose a penny. That's the beauty of a strategy like this. Think about that in your retirement. Very different dynamics. That's why when the market tanked in March and April, we held up so much better. And then the last one I'm going to go over is ONIOC. So this is a master limited partner. Excuse me, it's not a master limited partnership. It's a pipeline company, but they're a corporation. Okay, so the best comparable for them would be Kinder Morgan. A lot of these pipeline companies are structured as master limited partnerships. This one's not, so you don't have to do a K1, which is kind of a pain in the rear end. On January 14th, the stock was at 74.25. What we're going to do is we're going to buy 100 shares, and then we're going to sell a January 2027 $85 call for 425. $425 we're collecting. The maximum risk is $7,000. Once again, folks, options are simple if you do them like this, heads or tails. If ONIOC expires above 85 in a year, you're going to collect the full target profit of $425 from the option, which is 6% on the maximum risk. You'll have made $1,075 on the stock appreciating. Plus, you'll have made the annual dividend of $4.12 per share, or $412 total. So the total return would be $1,912 on $7,000 of risk, or 27.3% in a year. Tails, if ONIOC expires below 85, you're going to own 100 shares at a break even of 70, and now you have all the upside or downside from there. So therefore, the stock could go down 5.7% by expiration before you lose a penny. And if you add that 5.5% dividend, your break even would be about 11.2% below the current price. The 52-week range of ONIOC is 64.02 to 111.02. So once again, very undervalued stock, good balance sheet, good cash flows, not a lot of commodity exposure. It's a pipeline, so they're more into the transportation business. But these are great ways to generate a lot of income, not take a ton of risk in your portfolio, not be exposed to the bubble valuations. And in summary, that's our January 2026 investment strategy. If you have any questions, give me a ring directly or email me. There's our website. We use Schwab as our custodian, as most of you know. And our most popular program is just our managed account. So thank you so much for taking the time. And let's have a great 2026. Really excited about this year and all the opportunities that we have.